Hi, everyone. John Boardman here, founder and CEO of Ballast, and I'm thrilled today to be recording our Advocate Roundtable podcast. We'll be presenting this both in video and audio form. Joined today by Andy Reynolds, who's partner and COO, Brian Burton, who is partner and director of portfolio strategy, Cameron Hamilton, partner and director of financial planning, and Frank Yoswick, who is director of estate planning and tax. So today, we've recorded a few of these podcasts and videos and commentaries, I should say, up through the midst of this coronavirus crisis, and it feels a little bit like a baseball game. It's just a little difficult to tell you which inning we're in. Are we in the early innings? Or are we coming to an end? And I think so much of what we wanted to talk about today is the range of outcomes, because really we are looking at an undefined outcome here, both in the magnitude of the issues created by this crisis, but also the amount of time it takes for these issues to resolve. So Andy, I want to start with you. How would you assess the current state of the economy and where we're headed over the next few weeks and months?
Yeah, I think the current state of the economy can be judged in many different ways. Statistically, I think if you look at the numbers, it would be difficult to say we're not in one of the worst environments we've ever been in, a depression-like era. You look at Q1 of 2020 GDP and it's negative 4.8%, and we're expecting potentially 20% negative GDP Q2. We're looking at 30 million unemployed, potentially getting to 15 to 30% unemployment rate. So statistically, it's a very alarming time. But when you take a step back and you look at where we may truly be, I think there's a lot of reason to be positive and negative. If you look at the variations in sectors, airlines, cruise ships, entertainment, they're struggling significantly, and probably will over the next little while. If you look at tech, and whatnot, is doing okay. I was talking to a FedEx driver and had the same conversation with a contracted Amazon driver, and they're more positive and grateful, but more positive than they've ever been. They're busier, working more hours, seeing more people hired within their organizations due to the change in the way our environment's working. Manufacturing doing okay relative. Healthcare, interesting thing for healthcare. We have a lot of physician clients, and we have some who are working their tails off and barely keeping up, and we have others who haven't been to work in quite a while. So it's really not a economy that we can judge on a certain set of criteria. We are in an unprecedented time, like most crises are, but an unprecedented time where we've hit the pause button. And as we push the play button back, which we're starting to do, it's really going to be indicative of where we truly are. Because I don't know anybody really knows where we're at right now. We know that people have been laid off. We don't know whether that's temporary. We hope it's temporary. We know that there's been a lot of government stimulus that's helped prop up the economy and propped up people and consumers, which has certainly helped. But given all of the unknowns, we really don't know where we are. I think positively, we're definitely not as bad as we could be. We could be in a whole lot worse place easily. We're not in the best case scenario either, but we're somewhere in between. Really the next 4 to 8 weeks, I think, are going to be very telling of truly where this economy is and how quickly people are willing to get back out to a normal environment and get back out, hopefully safely and doing it responsibly, but getting back out to start to consume again and live somewhat of a normal life again. It's not going to be quick, but I think it'll be interesting to see how that all comes out. So current state of the economy, we can look at statistics and whatnot, but I don't know that those truly tell the story. But I also don't know that anybody exactly knows what the narrative is right now, other than there's a lot of unknowns, and the next couple of weeks are going to be very telling of where this economy truly is.
Yeah, I think there's there's this current economic state that we're in the middle of this shutdown, and then this sort of transitional economy we're going to go into when we're opening back up. And then I think there's just so many questions about what the actual economy can look like once this is somewhat in the rearview mirror. Brian, I want to throw it to you, more specifically about the markets. I think some people, I think we would be included in that group, sort of pleasantly surprised with April's market performance, particularly after March just being so treacherous. What do you attribute sort of the market activity to? Really looking back to March and then the somewhat of the recovery of April.
Yeah, the move we saw, from mid-February through the first half of March was, a pretty significant drop. I think that's attributed to several things, obviously, mostly the virus. But as far as the bounce that we saw in April, I think it's a couple things. First of all, you have to think back to that time when the markets were in free fall. So we pretty much ran the full cycle of investor emotions, which normally can take years to go through that entire cycle. We ran that cycle in 5 or 6 weeks. Markets were at all-time highs in mid-February. There certainly was some euphoria out there. The momentum stocks were going up so fast, and and that was before the virus really gained significant traction in the U.S. But as that threat increased, that euphoria quickly turned, into anxiety, fear, panic, and then ultimately what felt like despondency by late March. And typically that starts to form at least a short-term bottom with some capitulation selling. Markets were opening limit down. We saw circuit breakers triggering almost daily. It started, unbelievably, it started to feel somewhat normal when the market would be paused for 15 minutes. So, I think a lot of the bounce back that we saw in the month of April can be attributed simply to just very oversold conditions. And then you couple that with some very aggressive moves by the Fed and other central banks around the world. You get some hope that parts of the economy will reopen, and boom, you get a nice 20 to 25% pop. Also, it's important, don't forget that for weeks, we were fed bad news from a fire hydrant. It was very difficult to find any sense of positive news anywhere. So when we started to get these glimmers of hope, the markets were ready to bounce back, and that's exactly what we saw.
Do you attribute any of the severity of the pullback to 2019 being so positive?
Absolutely. We saw a huge run up towards the end of the year, and it wasn't based on valuations. It looked overbought at that time. So not surprising to see, a portion of that pullback be attributed to just overvaluations.
Yeah. Cam, I want to throw it to you. We hear so much and read so much about the consumer being so important to our economy. Obviously, this crisis has hit the consumer hard with unemployment numbers just at historic levels and increasing each week. How are you looking at the consumer right now, and what do you expect the consumer to look like coming out of this period?
Yeah, thanks, John. I think about the consumers in kind of different slices. I had a conversation last week with the director of tourism in Lexington, and her job is to get people out, bring people in, get people spending largely. She's an economic development person, and she said the people she's talking to, a lot like us who are lucky enough to still be employed, are kind of making that post-shutdown bucket list of the restaurants they want to visit and the places they want to go. And I think for a lot of people, especially the types of clients that we're working with, where many of them are retired, or also a lot of white collar people who have been lucky enough to stay employed, there will be a big bounce back in their consumption, Q3, Q4, hopefully. But we need to be cautious to not tell ourselves a story that those people are the engine of the consumption economy. And I was kind of curious about this week, so I went and looked up the BLS consumer expenditure numbers from 18, and the bottom 50% of incomes, which is all households below about 62,000 a year in income in 18, they make up like 30% of entertainment spending, 35% of fuel. So, that bottom half of the economy, who I think we assume is living paycheck to paycheck, for them to get back consuming like they were, I think every week this goes on, the damage that they have on those households is more severe. And I've also been following a study, a consumer sentiment study about how long people predict that the shutdown will last, and they've done it every week. And the estimate started at median of 4 weeks, and now it's gone up to 8 weeks. So I think people are seeing more data and making the decision for themselves when it's time for me to go out and live a normal consumption lifestyle. And I'm sure Home Depot's doing great because I've been doing projects around my house, but I'm not talking to a lot of sit-down restaurant owners who are excited about the prospects for their business in July. So I think there's definitely going to be winners and losers in the consumer economy, but I think it is really dependent on how federal and state governments handle opening back up, and then how that trickles down to the base of our economy, and how deep the pain is for those households getting back to consuming on their normal level.
There's an interesting video interview on 60 Minutes from Sunday about a catering woman who, she was talking about when she would be back to normal, and she took you through a stepwise process. First, the government has to open up and allow her to work, and then people have to be willing to go out and be in groups again. And then people have to be willing to take a risk to invite people to come to a big event. And then people have to be willing to go to that big event. So you think about that and the consumer thought process behind that. It's really interesting, kind of how those dominoes will fall.
Yeah, I think that realization, the shutdown, as difficult as it seemed, really was the easy part. The reopening appears to be the hardest part, because you obviously have differing opinions, and what seems to be in some cases sort of the goalpost moving on what it's going to require us to be able to open up. I think that probably is attributes to that extending timeline people are expecting at this point. Frank, Andy mentioned some of the sectors and industries that would be impacted by this. What are your thoughts on certain industries, and how this situation could temporarily or permanently alter how they look?
Yeah, thank you. I think that there's going to be a whole segment of industries that I'm kind of looking at them like the stay-at-home industries that have really gotten a lot of exposure, and people really using them lately because they kind of have to. I mean, I think you can break it down into your social and work categories, like us right now on a Zoom call. That's become normal for people going to the office and talking with their families and staying in touch with friends, and using other different kinds of apps like a house party type app where you can still meet with people and see people even though you have to be doing your social distancing. And I think that's part of it that's going to get more popular and stay popular. I think too, your food industry, if you're looking at things like a Blue Apron or a HelloFresh, I think those are going to start becoming much more popular, with people having to cook at home instead of being able to go out to the restaurant. Obviously the takeout is still a thing, but I think people are going to be cooking a lot more from home, and that's going to be an industry that's being forced on a lot of people now that will stick. Entertainment, always the Netflixes and the Amazon Primes, but that's not really new. I think that's just going to continue as is. At home fitness, you look at something like a Peloton, or even local gyms around town. They're having to get creative with what to do with their current members. And I know the gym that we belong to is reaching out and saying, hey, we'll do virtual personal training so that they can keep their business going and you can continue on with doing the fitness that you want to do. And I've even seen or heard actually on the radio, interesting and creative commercials. I heard one of a car dealership that said, if you need an oil change, we will send someone to your house to pick up your car. We'll take it in, we'll change the oil,
Wow.
we'll clean it, we'll sanitize it, and then we'll drop it back off for you. So it's the whole contactless delivery of an oil change, which is, fantastic. And think how convenient that could be for if you've got to go to the office and work all day on a quote unquote normal situation. How great is that in terms of convenience? And I think there's going to be a lot of creative solutions like that for this interesting time that will stick.
Yeah. It's, I think people sometimes underestimate human ingenuity and their ability to evolve in the middle of situations like this. So I think every company, I've been just blown away with what companies are willing to try to do just to kind of keep the doors open. It's really inspiring in so many ways, because this hit them out of nowhere, and they have limited resources, and they're making the best of it, and hopefully their business will be stronger for it, assuming they can weather this period of time.
Mm-hmm.
Andy, let's get back to the economy. I think the most recent major crisis that most investors have dealt with was the financial crisis. And I think there's just an immediate tendency to try to draw comparisons between that period and now. How do you look at that period of time, call it 2007 to 2009, 10, versus this window that we're experiencing now? Obviously we're in the early periods of this one, and that was a much longer period of time, but what comparisons would you draw today?
Yeah, I think, we could do an entire presentation on that question alone. But kind of high level, couple things. I think the way you phrase the question is important. This period of time versus that time. And I think we are in a window of time, like you mentioned here right now, that at some point this will be behind us. Sooner the better. But at some point, we will have a vaccine or a treatment or something. We have the brightest in the world working on that. And I think most agree that it will be solved at some point. The financial crisis was much different. The financial crisis was a very scary time of what our infrastructure was built on from the banking system was on the brink of collapse, and, the things going away. And that was very, very different, very scary. Right now there are similarities. There's the uncertainty, and it kind of came out of this hidden risk, like the financial crisis. There's this hidden risk of subprime lending and what people thought were safe investments, just like this hidden risk of this invisible virus that we could all be exposed today and not know it. And so that just generally there's a significant fear in people today. Markets, in both we saw a very quick collapse. This financial collapse was a whole lot faster, but that one was pretty quick too, and both pretty deep. The fear of just not knowing what the banking system would look like versus today, not knowing if you and your loved ones are going to be healthy in 2 weeks from now. Those are similar. PE ratios are high in both, as Brian alluded to. The Shiller's PE ratio, which maybe is a better one to look at today based on not really knowing what earnings are going to look like in the future. We're at 22 in 2020 and 25 in 2008. Ultimately, though, both unprecedented times, but I would argue almost every major event like this is unprecedented. You know, you just look at the most recent ones, and this, you know, pandemic, fairly unprecedented. Financial crisis, fairly unprecedented. The dot-com bubble, you know, we'd never experienced that before. So very similar in the way I think any type of major economic disruption happens, but fundamentally, I think very different. I think fundamentally, you know, the consumer is in a much better place today. Banks are in a much better place today. You know, the economy is, although maybe on the verge of getting a little excessive, I don't think we're there yet. We weren't seeing a ton of significant risk taking. You know, we're definitely not in the trough of the market or the economy, but I don't think we're where we had that silly money flowing yet. You know, this is different in that it's a self-made economic pause, and we could, if there's a treatment tomorrow, there would be no comparison. You know, we could all open back up and keep on rolling, and there may be, you know, we don't know when that will happen. So there could be a very swift recovery, whereas the financial crisis was very slow, and, you know, many would define recovery as many years later. The Fed, and we'll talk about the Fed in a little bit, but the Fed is now experienced with how to react to these things and ready to make big moves. You know, the one difference, I think businesses may be a little bit more exposed this time. But again, the big thing that I see different is just the fundamental impact of collapse of a banking system versus a pause. I don't think you can really compare the two, other than they're all unprecedented. How we work ourselves out of them are going to be difficult. But I don't think it was the reckless behavior that we were experiencing in 2008 versus today.
Yeah, it's interesting. You know, that period threatened the existence of some of our largest companies, which by all accounts, I mean, we've seen some corporate bankruptcy, but for the most part, it looks like most of these companies will be able to weather this. We're dealing with, from the other end of the spectrum, from a business standpoint, it's our small businesses that are going to be, that have been immediately impacted. And it's like, what kind of economic damage will that create that will flow through? And to your point, you know, one was really human created by risk and excessive just greed. And this one, you know, you can't really point a finger to anyone. This is just sort of a natural occurrence that happened that we're all having to deal with. It's quite unique.
I think also to your point about greed, you know, in today's environment, there's no finger pointing. Well, there's starting to be bigger picture finger pointing, but within the U.S., there's no finger pointing. You know, it's nobody's fault. It wasn't Wall Street or, you know, corporate America or, you know, whatever. We're all in this together, and I think ultimately that helps us get out of it quicker. You know, there's been so much kindness that we've seen publicly, we've seen privately within our communities and our clients, and you know, it really it's very different in the cause and people's reaction to it at this point, at least.
Yeah, good point.
And Andy, I'll just hop in there, and when you talk about kindness and community and everything, one thing I'm looking at and having a lot of conversations about is the nonprofit sector, and they are really having difficulty right now. You know, people don't have the certainty to donate, and then also a lot of the fundraising activity and events that happen this time of year through the fall might not happen. So just a little plug for anybody, if you're, you know, thinking about giving, it's a good time to do it. And we're always happy to talk to people about the best way to do that.
Yeah, good idea. Brian, I want to ask you, you mentioned the Fed's response to this and sort of evolving response. I feel like every week or so we hear some new action they've taken. Do you think they're done, or do you expect further action? What action could you see coming from them over the coming weeks and months?
Yeah, the Fed's definitely taken a very aggressive approach to this period of time. Basically cut interest rates to near zero. They have instituted several liquidity programs that were absolutely necessary, keeping financial markets functioning properly. Even the most liquid market in the world, U.S. Treasuries, was having liquidity issues, and the Fed stepped in very quickly to shore those up. They've also been purchasing Treasury and mortgage-backed securities, and even most recently jumped in as a buyer in the high-yield bond space. So some unprecedented moves, certainly, by the Fed. As for future moves, it's hard to predict. I don't think that we'll see negative interest rates in the U.S., but I don't think it can be completely ruled out. But more importantly, I think we'll continue to see the Fed flood the financial system with liquidity. Credit is the lifeblood of our economy. It doesn't matter if interest rates are zero if consumers can't get a loan. All right, so. And quite honestly, we won't know how successful these measures have been, that they've taken until much further down the road. But we can say that the responses they've made to this point have definitely improved sentiment. And that has a major influence on people being able to take on risk going forward. So definitely some important things they've done. As far the fiscal side, the response there has also been quite strong. We've seen a $2 trillion stimulus package. They include several different items, loan facility that's helping some of the more affected industries. We've seen direct cash payments to individuals. So loans for small businesses and even expanded unemployment benefits. So the governments have shown markets they would intervene as much as necessary, to keep them operating well. And I don't think they're done. I'm not sure what the next package is going to look like. I think there's something on the table actually currently for another fiscal stimulus package. So no, wouldn't be surprised at all if we see even more additional stimulus down the road.
Yeah, I mean, it's easy to nitpick issues with some of the fiscal stimulus, but you have to applaud the expediency of the response. And I think, going back to what Andy was talking about, one of the issues was just the response was so slow, particularly from the Fed, and there wasn't much action from a fiscal response during that time. Then I think that may have been what helped sort of reverse sentiment, at least temporarily, back at the end of March. Cam, so Brian referenced rates being quite low. They've been low. We've been telling people they're low, and now they're lower. This obviously has a direct impact on investors, both for savers, cash holders, and fixed income investors. Why don't you kind of give some details about how we're handling that internally for clients?
Yeah, it's not a good time to be a saver, is it? I've been watching CD rates and short term, less than a year CDs that we were getting 2% on. They're like 25 basis points, a 0.25% now. In my career, and I think, just any time in memory, the difference between what you're yielding on these different fixed income instruments, treasuries of any length, and the difference between that and cash has never been smaller. So we need to think about the cost benefit for our clients on what are we gaining in yield and risking in volatility of price, because when rates came down, through swift Fed action early on in this, existing bonds look way more attractive, and so their prices are elevated, and rates can't go any much lower. Brian talked about the prospect of negative rates, but if you're betting on how far rates can swing one way or the other, I think it's safe to say that there's a lot more room to the upside than there is to the downside. Not a prediction of time or anything, but we need to think for our clients about the price of the bonds they're owning. So, as rates came down, we were making that cost benefit analysis, and on a lot of them, as the values popped up, we decided to get rid of some, especially treasuries, and move to cash. And we're kind of thinking, and we kind of always have thought about cash as a portion of the fixed income, just the less risky side of the portfolio. And I think that that's definitely a leading part of the philosophy today. So we're thinking about those all together and constantly evaluating that cost benefit. So what are you getting in yield? And then what are you risking in price volatility? Are your fixed income positions a place to preserve capital? And we're going to keep making that evaluation as we, look for rates to normalize a little bit, and maybe find an entry point we're comfortable with in some of those positions we trim. But I think that that's something that is going to be a topic we're paying very close attention to on the portfolio management side, indefinitely this year.
Andy, you made some good points about cash and liquidity and, what that represents for clients. I think sometimes there's some confusion around why we hold cash, why we hold fixed income. Do you want to give a couple points related to that?
Yeah, so I think, ultimately what's our role and what's our job for clients? It's to help be a proactive voice of wisdom using a methodical approach. So, to Cam's point about the risk versus reward, if you look at some of these bonds and the yield, as Cam was mentioning, the yield that you're going to return as a positive for owning that position versus the risk of rates going back up, even modestly, and losing principal protection. It's a challenging time. I tell everybody that it's more difficult in the bond market than the equity markets right now. And it has been for a while, because ultimately what those bonds are to get you some type of lower risk yield, but also to serve as the ballast in the portfolio. And when you don't have the shorter term bonds and you don't have the lower end of the spectrum in a really safe spot, you really got to just question the stability of what those bonds provide for people. So, I think we made a good move and just kind of sidestepping out of the bond market for a portion, not everything, but for a portion for clients. And it's not that we're trying to time the market. It's not that our crystal ball all of a sudden is charged up and ready to go. It's more so getting back to the risk reward analysis, and the reward's so small at this moment that we just thought that was a prudent thing to do, and that's not always going to be the case. We're just in a unique environment that could change tomorrow. I mean, I think that's one of the things also that led to that decision was things were moving so quickly. We for the moment we just wanted to sidestep. And then additionally, I think we're all fairly optimistic about where we are with this thing. This morning I was reading an article, Goldman Sachs has called for a bottom already in the economy and in the markets. But this could impact anybody in many different ways. So we just want to also responsibly provide a little bit of liquidity for people. Again, letting that lower end of the risk spectrum serve its purpose of having the liquidity option if someone needs it. And if there is another pullback, giving us some dry powder to potentially put some more money to work as well.
Yeah, and just from the planning side, Andy, when you talk about that and when we look at these low yields, I think the trap there is people say, well, maybe I should just be looking for high yielding equities and moving a portion of that into blue chips, but we need to always make sure that we have ample liquidity, for whatever the client's scenario is. So we're trying not to fall in that trap that I think a lot of consumers, retail investors might.
That's right. We don't want to be chasing yield or chasing returns. And there's a huge trap right now, to your point, going and trying to get a CD in today's rate. I remember less than a year ago, probably about a year ago, looking at a 5-year CD paying 3.5%. It's crazy. And that was really good. I don't know how they're doing that. But, now it's a third of that, if that.
Yeah, it's and relative to previous periods, 3.5% looked pretty low. It's definitely all relative for sure. And hopefully, when this clears, you see some normalization. I mean, even if it's just slight normalization of interest rates, energy prices being in a similar boat. You hope you just see some of those things just drift up in price when people feel like there is a little bit more of a blue sky out there. Frank, I want to throw it to you. Low rates, great for real estate investors, typically, home buyers, home owners who want to refinance. What are your thoughts on this environment, sort of how it's going to impact real estate during this window we're dealing with, but also in the wake, or I should say after this passes?
Yeah, sure. So especially for the homeowner and the first time buyer or the whatever second, third time buyer, the lower rates on the mortgages are fantastic. If you have the opportunity to refinance and it makes sense, there's definitely some really low rates out there today in terms of being the owner occupier. If you're looking at real estate, though, in terms of being an investor, I think what you're talking about, the two different windows of the right now, short term, and then the longer term, there's some things that you got to keep in mind. If you're looking to be a real estate investor to buy like a single family home and flip it in the short term, you got to think about, well, getting people in there to do some work on that place and fixing it up if that needs to happen. Chances are, if it's a flip, there's going to need to be some work done. Make sure that you're going to be able to get somebody in there to do the work, because everybody might be staying home worrying about the virus. Once the place is fixed up and if you're ready to sell it, we're seeing that a lot of potential home buyers are not really too keen on going out and walking through a stranger's house. They may want to stay home where they know that they're in their safe spot and it's clean, and they're not really sure what's going on over here. And for a few weeks or months, that may be throw a little wrench in the operation. In terms of being a real estate investor in the short term, to be a landlord, a lot of your tenants might be losing their income. So your income stream might have to be adjusted in terms of, lowering rents to let people stay there, or, maybe you can find a way to come to some kind of an agreement with your tenants. But I think that's something that you need to really consider. I think longer term in the residential space for being either flips or landlord, I think things kind of normalize out. But then when you think about the longer term landlords in the commercial space, I think, again, what we're doing right now on Zoom and what every other company in America is doing on Zoom, a lot of businesses are going to realize, hey, I don't need 3 floors in the main building down on Main Street after this all clears up. Maybe I only need 1 floor. Maybe I only need half the space or whatever it was. So I think that longer term, there definitely could be some shakeups in the commercial real estate industry for sure.
Yeah, I read a study, and I may butcher it a little bit, but it was discussing Amazon's projected growth curve over the next 10 years. And they said this window is likely to speed that up to the next 3 to 4 years. If you think about the implications on retail, for instance, that obviously was happening. And if you look at a lot of the companies that are going through bankruptcy protection, they're not shutting down, but what they're going to do is they're going to, figure out some way to deal with the debt that they have and reduce the number of stores that they have and break leases and things like that. And it just feels like every company is now going to look at this window as a risk that now exists. And even though it may not repeat itself during our lifetimes, it now exists as a risk. And I think people will position their businesses accordingly and think about, how can I run it without all of the space that I was leasing before, and potentially without the number of people. And those are the things I think that we just won't know until this plays itself out.
I think, just to interject, I think one observation that we had as a family, which was somewhat alarming, getting back to the home gym, I was looking for weights for my wife, and obviously the only ones I could find for a 5-pound weight was about $28 from some medical supply company, which I did not purchase. But I just got to be thinking, where do I even go to shop? I'm so addicted to e-commerce. I went on Amazon's website. I went on Target's website. I went on Walmart's website. And then I kind of paused and I was like, where else do I go? And I think this is going to further deepen that. I don't know if it's addiction is the right word, but we as a society have become so accustomed to not only being able to go online and click and get something, but also to be able to get it in a couple days. This is an unprecedented time where from what I can remember, I know, 10 years ago is different, but in the most recent memory, if you want something within a couple days, you can get it. There's some things you can't get right now. And that's, it's an interesting phenomenon when you talk about commercial and retail. I think that this is going to change that space.
Yeah, I think that's a great way to wrap it up. I think talking about just being able to do simple things that maybe we've all taken for granted, and maybe that's the most positive thing that comes out of this window is that, we all live that. I love what Warren Buffett says. It says, even the middle class, median income individual in this country lives a better lifestyle than John D. Rockefeller did, just based on lifestyle and quality of life, I should say, that we all, I think, appreciate more so than ever when periods of like this happen. And we're all optimists by nature. I think that is a great quality in an investment group, because we are looking to the future, and we have to have faith in the companies that we're invested in and their ability to navigate periods like this. So I think it will be society's finest hour, but it's going to take us, it's going to be a treacherous ride, I think, until we get out the other end of it. But much like what you were saying, Andy, and others, we will get through this. And the important thing is, we're financial planners at our core. And although the next year is a really important period for anybody, we're most concerned about the next 10, 20, and 30 years for our clients, if not longer in some cases. So it's important for us to keep our eye on the prize of what our clients really need. And overreacting in an environment like this is likely the worst thing that we could possibly do. So we want to thank everybody for listening today. We've been experimenting with different formats. And as I said in the intro, we will be sending this out via video as well as a podcast audio stream. So we appreciate you listening today, and please give us any feedback on any way we can improve these commentaries from time to time. Thank you.